Let's be honest. Most people pick their crypto investments based on pure emotion, and it's a recipe for disaster. It's a familiar story. You're scrolling through your feed, and a coin you've never heard of is suddenly everywhere. The chart is a solid green wall, and the comments are filled with rocket emojis and promises of life-changing wealth. This is the moment where rational thought often takes a back seat. The fear of missing out, or FOMO, kicks in. It's a powerful, primal feeling whispering that this is your one chance, that everyone else is getting rich and you're about to be left behind. Maybe you see it trending on Twitter. Perhaps a YouTuber you follow mentions it with breathless excitement. Or a friend who just started in crypto last week texts you with an urgent tip. So you jump in, you transfer your funds, you click buy at the market peak, and for a moment, you feel the thrill. Then, the inevitable happens. The hype fades, the early investors cash out, and the chart turns from a beautiful green into a terrifying, steep red line. It crashes. You're left holding a bag of digital dust, wondering what went wrong. The problem wasn't the coin, it was the process, or rather, the lack of one. There is a much better way, a calm, methodical, and repeatable process that removes emotion from the equation and empowers you to make informed decisions. Before we dive in, a quick reminder. This video is for educational purposes only and is not financial advice. Always do your own comprehensive research. I'm going to walk you through the exact 6-point AI-assisted checklist I use for every single new crypto I consider. This isn't about finding a magic formula to predict the market, it's about building a robust filter. This process, which takes about 20 minutes, is designed to systematically identify the most common red flags and help you filter out at least 80% of bad investments before you risk a single dollar. I use this religiously, and today, I'm giving it to you, completely free. So, if you know anyone who's about to buy a coin they just discovered on social media, do them a favor and share this video. It could be the most valuable click they make. Point 1. What problem does it solve? This is the most fundamental question, yet it's the one most often ignored in a hype cycle. A cryptocurrency with long-term potential isn't just a speculative asset, it's a piece of technology designed to solve a specific problem. Is it aiming to make cross-border payments cheaper and faster than traditional banks? Is it creating a decentralized data storage solution that's more secure and censorship-resistant than cloud services? Or is it just a meme coin with a cute dog as its logo? Your first action is to go to an AI tool like ChatGPT or Claude. Ask it this specific prompt. What real-world problem does coin claim to solve? Does this problem actually exist at scale, and are there established non-crypto competitors? The AI will synthesize information from the project's white paper, articles, and documentation. A green flag is a clear, concise answer that you can understand. For example, it solves the problem of high remittance fees for migrant workers. A major red flag is when the AI gives a vague, jargon-filled response about decentralizing the future or revolutionizing Web3 without a concrete use case. If the AI can't find a clear problem, it's highly likely the project is purely speculative, and its value is driven by hype, not utility. Point 2. Who built it? Behind every legitimate project are real people. In the world of crypto, the team's identity, experience, and reputation are your best proxy for trust and accountability. An anonymous team is one of the biggest red flags in the market today, especially as we move into 2026. Anonymity means zero accountability. If the project fails, or if it's a deliberate scam, a rug pull, the founders can simply disappear with investors' money, leaving no trail to follow. Your action here is simple but crucial. Go to Google and search for a coin founder's background. Look for their professional profiles on platforms like LinkedIn. Do they have a verifiable history in software development, cryptography, or finance? Have they worked at reputable companies or contributed to other successful open-source projects? A green flag is a transparent, doxed team with relevant experience and a public track record. You should be able to see their faces, read their work history, and find their contributions elsewhere online. If the founders are anonymous, pseudonymous, or have no verifiable past, consider it a hard stop. The risk of entrusting your capital to ghosts is simply too high. Point 3. Is there real usage? This is where we separate the talk from the walk. A project can have a brilliant white paper and a world-class team, but if no one is actually using the network, it has no fundamental value. Usage is the lifeblood of a crypto network. It indicates that the problem the project claims to solve is actually being addressed, and that people are finding value in the solution. We measure this with on-chain metrics. Your action is to go to a data aggregator site like CoinGecko, CoinMarketCap, or Masari. Find the coin and look for two key charts: daily active addresses and transaction volume. Daily active addresses tells you how many unique wallets are interacting with the network each day. Transaction volume shows the economic value being moved. A green flag is steady, organic growth in both metrics, ideally moving in correlation with the price. This shows a healthy, growing network. The most critical red flag is a price usage divergence. This occurs when the coin's price is skyrocketing, but the active addresses and transaction volume are flat or even declining. This is a classic sign that the price movement is driven purely by speculation and market manipulation, not by fundamental adoption. It's a bubble waiting to pop. Point 4. Who holds the supply? This point is about decentralization and risk. The distribution of a coin's supply, known as its tokenomics, is critically important. If a small number of wallets, controlled by the founders, early investors, or a single whale, hold a massive percentage of the total supply, the project is highly centralized. This creates a significant risk for all other holders. Your action is to use a blockchain explorer. If the token is on Ethereum, you'll use Etherscan. If it's on Solana, you'll use SolScan. Search for the token and find the Holders tab. This will show you a list of all wallets holding the token, ranked by the size of their holdings. Pay close attention to the top 10 or 20 wallets. A major red flag is if the top 3 wallets hold more than 50% of the supply, or if the top 10 wallets hold more than 70%. This concentration of power means that a single decision by one or two of those holders to sell their position could instantly flood the market and crash the price to zero. A green flag is a wide, healthy distribution, with no single entity holding a dangerously large portion of the supply. Look for a long tail of smaller holders, which indicates a more decentralized and resilient community. Point 5. Has the code been audited? We're dealing with technology that handles real money. The underlying code, particularly the smart contracts, must be secure. A single vulnerability can be exploited by hackers, leading to a complete loss of funds for everyone involved. This isn't a theoretical risk. Billions of dollars have been stolen from DeFi protocols due to unaudited or poorly audited code. Therefore, any legitimate project must have its smart contract code audited by a reputable, independent security firm. This is non-negotiable. These firms, like Trail of Bits, CertiK, or OpenZeppelin, specialize in rigorously testing code to find vulnerabilities before they can be exploited. Your action is twofold. First, visit the project's official website and look for a dedicated security or audits page. They should publicly display their audit reports. Second, verify this with your AI assistant. Ask, has Coin's smart contract undergone a third-party security audit? If so, by which firm and when was the report published? A green flag is one or more completed audits from well-known firms. The red flag is simple and absolute. No audit, no investment. It's the digital equivalent of putting your money in a safe with no lock. Point 6. What does AI sentiment analysis say? Our final check brings us full circle back to the world of social media hype where we started, but this time, we're armed with data. Sentiment analysis tools use AI to scan millions of posts on platforms like Twitter, Reddit, and Telegram to gauge the overall mood of the crowd. Is it overwhelmingly positive, negative, or neutral? This can provide powerful context for all the other data you've gathered. Your action is to use a crypto sentiment analysis tool. There are several available online. Run the coin's name through the tool. Now interpreting the results requires nuance. It's not as simple as positive is good and negative is bad. Here's where you look for divergences. A potential red flag is when sentiment is extremely positive or euphoric, but the price hasn't moved much yet and the on-chain usage is low. This can be a sign of an artificial, coordinated campaign to pump the price before dumping it on retail investors. Conversely, a potential green flag, an opportunity can be found when sentiment is negative or fearful, but your fundamental checks on the team, usage, and tokenomics are all strong. This could indicate that the market is irrationally pessimistic, creating a potential entry point for a long-term investor who has done their homework. Let's do a quick case study. Imagine we're researching SampleCoin. Point 1. It aims to create a decentralized VPN, a clear problem, green flag. Point 2. The team is public and has experience in cybersecurity, green flag. Point 3. Usage is low but growing steadily, neutral but promising. Point 4. We check the block explorer and find the top 5 wallets hold 60% of the supply. That's a major red flag for centralization risk. Point 5. We can't find any record of a security audit. That's an absolute deal breaker. We don't even need to get to point 6. Despite a good idea and team, the combination of centralized supply and unaudited code presents an unacceptable risk. We pass on this investment. This is the power of the checklist. It provides a clear, logical framework for saying no. Finally, remember that even with the best research, crypto remains a high-risk asset class. This checklist is a tool for risk mitigation, not risk elimination. Always practice proper risk management. Never invest more than you are willing to lose, and consider diversifying your investments rather than going all in on a single project. This systematic approach is your best defense against emotional decisions and the hype that pervades this market. To make this even easier for you, the full 6-point checklist, including the exact AI prompts and tools to use, is available as a free, downloadable PDF. The link is in the description below. I update this document quarterly to keep it relevant as the market evolves, so you'll always have the latest version. For those who want to go even deeper with professional-grade data and research reports, I personally use Masari Pro. It's an invaluable tool for serious analysis, and I've included my affiliate link for that in the description as well. If you found this guide valuable, please subscribe to the channel and turn on notifications so you don't miss future updates. And now I want to hear from you. In the comments below, tell me, what is one coin you are currently researching? I read all the comments, and I might just pick one to do a full, live checklist walkthrough in a future video. Thank you for watching, and invest wisely.